Hello viewers, welcome to my channel. I'm Hasham Ali Khan. In this video again I'm continuing the chapter number 6, that is accounting as a measurement discipline and valuation principles, accounting estimates. Last video, first topic I have completed, that is accounting as a measure of discipline. Measurement is a very vital aspect of accounting. So one of the definitions says accounting is identifying, measuring and communicating the financial information to the end users so that the users can be able to make informed judgment and decision making. So for that purpose, accounting is concerned with identifying, measuring, communicating. So measurement is one of the vital important aspect. So how to measure? Three aspects are given, that is first we have to identify what are the events, what are the objects to be measured. Second, what is the standard or scale to be used, and what is the dimension of that scale or standard. These three topics already I have explained you in the last video. So if you have not watched, go to the playlist of my channel, select the subject accounting for CA foundation, watch the video of chapter number 6, accounting as a measurement discipline. Be perfect. Now in this video, the remaining part, that is valuation principles and accounting estimates, I am going to explain. So these are the theoretical topics. The first 6 to 7 chapters are completely theoretical. After that, we will have the problems. But don't underestimate the theory. In examination, very frequently they will ask the theory question. And these are the foundation of accounting. Without understanding these basics, you are not supposed to go for further higher problems. So before explaining the valuation principles, take the screenshot of the points which I have written on the board. Then I'll explain every point in detail. Now, first of all, valuation principles. What are the rules of valuation? How to value the assets, liabilities, then incomes or expenses. That is called valuation principle. So, 4 generally accepted measurement basis or valuation principles are there. In order to value the assets, 4 methods are there. The first method, historical cost method. Second, current cost method. Then realizable value method. And lastly, present value method. These are the 4 basic accounting valuation principles. First of all, historical cost. It means the acquisition price. For example, the businessman paid 7 lakh rupees to purchase the machine and spent 1 lakh rupees on installation. Simply we can say historical cost. The historical cost means the amount which is paid for purchasing the asset. So historical cost, it means the acquisition price. For example, the businessman paid 7 lakh rupees to purchase the machine and spent 1 lakh rupees on its installation. Simply I can say like this, historical cost means the cost at which the asset is purchased. Here example, one businessman has purchased a machine for rupees 7 lakh and to install the machine 1 lakh rupees are spent. So the total cost of the machine is 8 lakh rupees. Because totally 8 lakh rupees he has paid to purchase and install the machine. So historical cost will be 8 lakh. So whatever be the amount paid for purchasing and installing, that is called historical cost. Its acquisition price includes historical charges of 1 lakh. So acquisition price including installation charges 8 lakh. The historical cost of the machine would be 8 lakh. According to this basis, assets are recorded at an amount of cash paid at the time of acquisition. So according to historical cost method, whatever amount paid in order to acquire, in order to install the machine, that is called historical cost. Now companies usually apply historical cost method in case of long-term assets like machinery, building, furniture, etc. So normally these non-current assets, fixed assets will be calculated, will be valued at historical cost. Second method is current cost. Actually current cost means what is the cost at which the asset will be replaced by a new one. in place of old one. So current cost gives an alternative base. Assets are carried out at the amount of cash or cash equivalent that have to be paid if the same or an equivalent asset was acquired currently. Presently we are using a machine. For example, the machine's historical cost is 1 lakh rupees. Now if we replace that machine with a new one, the new machine will cost rupees 2 lakh. So the current cost of the machine is 2 lakh, whereas historical cost of the machine is 1 lakh. So how much amount is required to replace the old machine with a new one? That is called current cost. Next one, realizable value. If we sell that asset, how much we can be able to realize, how much we can be able to get, that is called realizable value. As per realizable value, assets are carried at the amount of cash or cash equivalent that could currently be obtained by selling the asset in an orderly disposal. Suppose if we dispose of the asset, how much amount we can be able to realize, how much amount we can be able to get. For example, the historical cost of the furniture is rupees 1 lakh. But if we sell the furniture in the market, we may get 80,000 rupees. So we can say the historical cost is 1 lakh, but realizable value in the market is 80,000. 80,000 is the realizable value. Realization concept is commonly applied in case of inventories. So inventories are measured at the lower of cost or net realizable value. So normally this realizable value method will be adopted in case of inventories. One accounting principle is inventories should always be valued at the lower of cost price or net realizable value. That's it. Now last one is present value method. This is also one of the method of valuing the asset. So as per present value, an asset is carried at the present discounted value of all future net cash inflows that the item is expected to generate in the normal course of business. Example, a machine is there. How many years we can be able to get the benefit from this machine? Suppose we estimate the life of the machine is 10 years. So in the next 10 years we are going to get the benefit of this machine. So we calculate what is the present value of all the future benefits. First year, second year, third year, like that we make the projection of benefits, estimation of benefits which we expect in future 10 years. Now we find out the present value of all the future cash inflows. And the present value of all future cash inflows is the present value of the asset. And the concept of present value is common in case of accounting for investments. So normally some of the business houses, they will follow this present value method in order to calculate the value of investment, present value of investment. Simply, present value method means a method in which we calculate we discount all future cash inflows to its present value. That's it. Now this is the end of accounting principles. Now last topic of this chapter number 6 is regarding accounting estimates. See here, there are many items in the financial statements which are not objective but which are subjective. That means the management has to estimate by applying his judgment. By applying the judgment, estimate the value of the assets, estimate the value of the expense, like that. So the measurement of certain assets and liabilities is based on estimates of uncertain future events. The future is completely uncertain. So we have to estimate what would be the value of a particular asset or expense or liability or income. As a result of uncertainties inherent in business activities, many financial items cannot be measured with precision but can only be estimated. So many items are there in the statement of financial statements where the values cannot be precisely calculated. There we have to apply the estimations, right? And therefore the management makes various estimates on the assumption of assets, liabilities, incomes and expenses and so on the date of preparation of financial statements. So as on the date of preparation of financial statements, management has to make the estimation regarding number of assets or liabilities or incomes or expenses. And these items will be taken in the financial statements. Such estimates are made in computation of depreciation. So where the management has to apply subjective method of calculating. In case of depreciation, amortization and impairment losses, as well as accrual, provisions and employee benefit obligations. So these are some of the areas where management will apply estimations. Personal judgment will be applied, right? Also, estimates may be required in determining the bad debts, useful life of assets and residual value. Many areas are there where management has to apply estimations, bad debts, provision for bad debts. Similarly, expected life or estimated life of the asset. How much would be the residual value we can get in future? All these will require estimates. Finally, the process of estimation involves judgment based on latest information. Remember, arbitrarily, randomly, the management should not estimate. It should be based on latest information. On the basis of correct information, the management has to make the estimations of various values which are there in income statement and balance sheet. That's all. So this marks the end of theory of chapter number 6, that is accounting as a measurement discipline and valuation principles and accounting estimates. Inshallah, in the next video, I'll give few questions on this chapter number 6. Then we'll go for chapter number 7. So if you are satisfied, give a like to the video, share my channel, subscribe if you have not yet subscribed. Inshallah, we'll continue the problems in the next video.